So, Chance, it sounds as though then, I mean, your base case, your fundamental view right now is really more on the cautious side. Can you give a few more examples, economic data, because I think it has been very mixed as of late. Um, there has been a way to make the bull and the bear case. There's been no doubt about it. But I do think more recently we are seeing some slowing down effects. But PCE is still relatively high. In other words, we're still seeing inflation, and now you're seeing more people talk about stagflation, even though that was put on the back burner going back a couple of months ago. But give us a few more examples, economic data-wise, that make you concerned.
Yeah, just to touch on the PCE inflation that you mentioned, that core PCE number is one that the Fed has said they pay attention to. And Chairman Powell has said that he does not want to start cutting rates until all of the different Treasury yields are trading at a level below that core PCE. Well, right now, core PCE is still near 5%, and you've got the 10-year Treasury yield under 3.5. So he needs to see that come down more before he'd really want to look to cut. So just to follow up on that last segment, I think they're going to try and wait as long as possible before they have to cut. And maybe a furthering of this regional bank crisis could force their hand, but I really think they don't want to do that unless they absolutely have to. In terms of
Mm-hmm.
metrics that are more cyclical that we pay attention to, it's just the ways you can tell if there's strength in the financial markets and in the economy that point to an acceleration in things and it's time to be more aggressive. So this could be like looking at emerging markets compared to other developed markets around the world, or looking at the Dow Transports Index versus the Dow Utilities Index. You could look at what's happening with treasury yields. You could look at the performance of currencies of countries that have a lot of commodity business. So Canada, Australia, New Zealand. Compare that to more defensive currencies like Switzerland and Japanese yen. These are all areas where you're actually seeing a deterioration in the cyclical side and strength in the last 2 or 3 months on the defensive side. You could also look at large cap versus small caps, financials. Small caps and financials have been weak now for several months. So when we look at that, this doesn't tell us that that low that we made in the market back in October of last year was a great low to buy and hold for multiple years. It suggests to us that that might have been a short-term rally, but we need to keep an eye on further deterioration or negative news on the horizon.
It's interesting. You used the word mirage earlier, and I most of our viewers know that I spent my time on Wall Street, and I was on the sell side. And the sell side people are always the glass half full people. So I tend to be quite optimistic when I look at the markets. Realistic but optimistic. But I have to say, I'm pretty surprised that the market has been this resilient. I feel like it's almost too resilient for what I see out there. What would you say to that?
Yeah, I think there's a makeup of the market, especially if you look at U.S. large cap stocks. So the strength in the Nasdaq or in the S&P 500. In the S&P, for instance, half of the return that we've had this year has come from three stocks. It's Apple, Microsoft, and Nvidia. And the excitement around the development of generative AI and what that could mean, obviously, is very exciting, but it's so early. You don't even really know what the potential of that is and where that could go. So we would say that the speculation that's driving prices higher has gotten ahead of the fundamentals. And while that's great for anyone who's owned those positions, it's not something that we would be chasing and trying to buy at these prices. And then if you're looking at
Mm-hmm.
other cyclical sectors, even though you've got an overall market that's trading at 18 times earnings, which is above average, you've got other cyclical sectors that tend to fall down during a recession. They're starting to weaken. So financials, industrials, energy, materials, excluding gold, those are all starting to break down and suggest to us that this weakness could continue. But when we look at the valuations, they still say that they're only about fairly valued. They're not really cheap yet.
Mm-hmm. When you take a look at energy and the weakness that we've seen this week, why do you think it weakened on the back of the Fed yesterday?
There's so many inputs into the oil market. I don't know that that would be the one thing. I think what we focus on with something like the oil price is just the overall economic trend. And if you're just going back through decades of history, when you have a recession, which is what we think is still on the horizon, the oil price tends to go down and you don't really want to own volatile energy stocks in your equity portfolios. You want to wait that out. So we would just say to continue to stay defensive on that and expect the price to continue to be weak for a little bit longer.
Yeah, to me, it was a read through that the market is concerned about the Fed and that we'll see a significant recession. We'll take a quick break. We'll be right back.